Okay, thanks for joining us today. We appreciate it. My name is Gina Morais. I'm one of the advisors here at Summit Financial Group. And today I'm going to talk to you guys regarding the sequence of returns and why you should care. This is a presentation that we put together to help people with what we would call the retirement income challenge. After our presentation today, you'll have the opportunity to ask questions. If something comes up in my time frame, please feel free to type your question into the Q&A box. I will get to as many questions at the end of our presentation as possible. And as always, if there's additional questions, don't hesitate to reach out to us, either via email or phone. We're happy to have conversations with anyone joining us today. Okay, let's go ahead and get started. First of all, we're going to get started with a quick story. Does anybody know what happened on May 29th, 1953? It was the first recorded summiting of Mount Everest. This was a huge accomplishment. Think about the clothing, the equipment, and the technology in 1953, and what an amazing accomplishment all of those hikers and climbers were able to do. Even with the advancements in technology today, this is an amazing feat. In fact, people plan and train for months and years to achieve this goal. They hire coaches and Sherpas and trainers and nutritionists in order to complete the feat, and they don't go at it alone. They bring all sorts of equipment and technology. Unfortunately, not everyone who sets out to climb Mount Everest does so and is successful in making it off the mountain. A number of years ago, researchers at Massachusetts General Hospital did a study to see where people were having trouble. They were trying to help future climbers. Were they having trouble at that first base camp? They were excited and emotionally drained. How many were having trouble kind of right near the top, what we would call the oxygen-free zone? And then where were they having trouble at the summit? They got to the summit and then they weren't able to make it back down and collapsed at the peak. The study showed that most of the deaths on Mount Everest happened on the way down the mountain, not on the way up. Most of the planning and preparation went into climbing up the mountain, and not the same planning and preparation went into climbing down the mountain. This was a powerful finding. You don't just run down Mount Everest, you still have treacherous terrain, difficult weather, and lack of oxygen. In our business of retirement planning, we find the same thing is true. We work and save for decades to get to the fateful day of retirement, but very little planning or energy goes into what happens after we retire, and we still have treacherous terrain such as market volatility, inflation, medical expenses, and interest rates. At retirement, we become the CEO of our retirement account, and our new job is to make it down the mountain safely without running out of money, but keeping in mind that if we retire at 65, we've got a long trip down the mountain, possibly over 30 years. Much of the anxiety around whether people can afford to retire comes from not knowing what amount of income will be necessary to meet the next 30 years without a paycheck. Given that, it would seem natural to design a cash flow plan prior to retiring. However, very few people have a good grasp on their current expenses, and even less have projected those expenses for a 30-year retirement, including inflation. As a result, it's quite difficult to determine if they can afford to retire, or even possibly put their assets into a spending plan. In our firm, the cash flow analysis is part of a broader financial planning process. However, the key takeaway is determining your cash flow needs on a go-forward basis. With some thought and a few inflation assumptions, you can approximate your cash flow needs throughout retirement. Using software, you can get a lot more specific, but putting something on paper is a good start. Be sure to think about the nice to haves in addition to the necessities. Things like travel, weddings, college for grandchildren, and helping family members with first home purchases are some of the discretionary expenses that clients tell us are the most meaningful in their retirement experience. The areas that we're going to cover today are behavior management and the importance of it, old ways of retirement spending, and new ideas to think about as you work through your plan. With the invention of the internet and the morning stars of the world, most people can sit in the comfort of their home and buy and sell investments for their accounts on a daily basis. The one area that I would argue is going to be different than if you're doing this from the comfort of your own home versus hiring a professional money manager like us is going to be your emotions. One of our favorite studies each year is the quantitative analysis of investor behavior produced by Dalbar. The QAIB consistently shows that investors meaningfully underperform their own investments due to poor behavior. The latest study, what we're showing you on the screen right now, is referencing investment returns from 1992 to 2022. This shows that the average investor earned only 6.81% during the 30-year period in question. Meanwhile, the S&P 500 index earned over 9.65% during that same 30-year time frame. That's a gap of over 2.85%. Why is the gap between the investments themselves and the investor results so large? The answer is investor behavior. Nobody wants to sell their portfolio when things are going well, but investors tend to panic when markets swoon. This tendency to react when markets sell off can be hazardous to your portfolio. And if you think that your emotions are running high during your working years while you're saving into these investment accounts, emotions are going to be tenfold in retirement. You've stopped working and you've stopped saving into these retirement accounts, and now you're relying on these accounts as your income. In this next slide, this is a chart that JP Morgan illustrates every single year for us. And what it's showing us here is over the last 20 years, if an investor in the US market via the S&P 500 missed the 60 best days, their average annual rate of return was negative 4.2% versus the same investor who earned 9.8% over the same period by merely staying invested. And if we look at missing just the 10 best days in the market, your rate of return would have been 5.6%. And keeping in mind that 6 of the 7 best days in the market occurred right after those worst days. For example, the second worst day of 2020, March 12th, was immediately followed by the second best day of the year. Jump in and out of the market at your own peril. As you can imagine, as advisors, we spend an inordinate amount of time coaching and managing client behavior to avoid the biggest mistake of selling into a downturn. Although no one can predict the future, there is a mountain of historical evidence suggesting a diversified portfolio of equity investments outperform inflation over time. As such, investing in the markets has been a good way to grow one's wealth and help sustain a 30-year retirement in the face of rising expenses. However, staying invested and not panicking can be the key to success. In this next section, we're going to talk through some historical retirement spending strategies. This slide here is put together on an annual basis by bank rate. On this slide, you will see the average CD yields from the 1980s all the way up to 2023. As you can see here, in the 1980s, a 6-month, 5-year, and 1-year CD were yielding 10 to 11-ish%. Since the 1980s, we've seen rates on CDs come down, although in the last year or so, we have seen them go back up slightly because the feds have raised rates. When we talk about retirement planning, 30 or 40 years ago, retirees would put all their money into a CD and live off the income. If they lived off the income 3 decades ago, certificates of deposit were paying much higher interest rates, as we just mentioned, and many retirees positioned their portfolios in CDs or fixed income securities to live off the principal or to live off the interest and not touch the principal. The 30 years hence have seen a continuous decline in interest rates until present day, where CDs only pay a fraction of what they paid then. To illustrate this, even given our current interest rate environment, the retiree who retired with $1 million in savings in 1984 received almost $100,000 a year in income, whereas that same million might only earn that retiree today $50,000 a year in income. Factor in the cost of living, which would have doubled over that time period, and you have a recipe for disaster. If a retiree was planning on spending 100% of the income from the portfolio each year, their standard of living would have had to decline dramatically. For those contemplating retirement today, this strategy is untenable, as the portfolio would have to be very large to support 30 years of income. In 1994, William Bengen introduced the 4% rule, which positioned that 4% was the maximum amount one could safely withdraw from a portfolio composed of 50% stocks and 50% bonds, while increasing the withdrawals for inflation each year for 30 years. He later revised this to a 4.5% withdrawal rate by adding some other investment classes to the allocation, but the original moniker of 4% stuck, and it became accepted practice in the industry of financial advice. Much has been made of the 4% rule in the last few years. Many claim that in the wake of the Great Recession of 2007 to 2009 and the recent COVID-induced panic of 2020, that stock returns may not approach their historical averages, while bonds are paying a fraction of their former interest rate. Thus, something closer to 3% may be more realistic in the current time frame for recent retirees. We find the 4% rule to be a blunt instrument in determining a 30-year strategy for each particular client. Sometimes client needs require more than a standard inflation adjustment for life's unexpected changes. And there are often other sources of income or inheritances that can factor into the analysis. In addition, Bengen's analysis assumed that the portfolio was rebalanced annually and that investors never sold their portfolio regardless of the market environment. As we'll see in these next few slides, that is rarely the case. Perhaps the most perplexing risk of the retirement income challenge when you're planning for retirement is something called the sequence of returns. Advisors can calculate your income needs and build corresponding spending strategies for you. They can coach and counsel you to not panic during the inevitable market downturn. But advisors cannot control the markets or the sequence in which you experience small investment returns. As you'll see, not all returns are created equal. In fact, portfolios with the same long-term average rate of return can have dramatically different outcomes. To illustrate this, let's look at these next few slides. So this is the first of two slides we're going to walk through for the illustration. Bear with me because we're going to first take a chance to look at Calvin here. So Calvin and Hobbes are the two men that we're going to look at as we go through this example. Both of them have mythical portfolios over a 30-year time frame with an average annual return of 6%. Both Calvin and Hobbes retire at 65 and withdraw 4% from their $1 million portfolio. Same set of circumstances. Both adjust that 4% withdrawal by 3% each year for inflation. So it goes up each year by 3% for inflation. Same set of circumstances for both Calvin and Hobbes. As you can see here on the slide that we're showing you now, Calvin had the good fortune of retiring into a nice bull run in the market. His first 4 years of retirement, his rate of return were fantastic. He got 10%, 16%, 10%, and 9%, as you can see in the green highlighted box. Although he experienced downturns later, his portfolio was larger at age 94 than it was when he started, even despite his withdrawals adjusted for inflation. As you can see here, Calvin is a happy camper. He was able to retire, maintain his financial independence, and increase his withdrawals each year for inflation. On the other hand, Hobbes had the misfortune of retiring into a bear market. Now, as I explain this to you, keep in mind, same set of circumstances. $1 million at retirement at age 65, a 4% withdrawal adjusted for inflation of 3% each year. Unfortunately, Hobbes retired into a bear market. His first 3 years, as you can see in the box highlighted in red, he had negative 10%, negative 10%, and negative 2%. And those negatives were also occurring while he was withdrawing from the portfolio. So his assets were depressed by those negative returns. Although he experienced better returns later, the damage was already done, and Hobbes exhausted his portfolio by the age of 89. Now, keep in mind, each of these guys had an average 6% rate of return over that 30-year retirement time horizon. The only difference in the two scenarios is that Calvin retired into a bull market and Hobbes retired into a bear market. Hobbes may have been forced to tap into the equity of a home if he owned one, or significantly lower his expenses to preserve his nest egg. The key takeaway with these two illustrations for you is that downturns in the early years of retirement are the most damaging. Taking withdrawals when the entirety of the nest egg is depressed puts significant strain on the retirement income plan. On the other hand, good returns in the early years overwhelm the withdrawals, and the compounding effect on the larger nest egg can be enough to withstand bear markets in later years. This next slide is an illustration of just that. Retirement researcher Dr. Wade Pfau illustrates this concept in this slide that shows the relative importance of each year's annual return throughout an investor lifetime. The chart assumes that years 1 through 30 are the accumulation years, where one is investing money before retirement. Years 31 through 60 are the withdrawal years, post-retirement. During the savings years, the relative importance of each year's return increases leading up to retirement. However, the first 5 years after retirement are far more important than any years before or after. Some have dubbed this the retirement red zone, where much of the success or failure of the plan is decided. On some level, this is disconcerting to both investors and advisors. After all, predicting the first 5 years of returns after your retirement date is akin to predicting the first 5 rules at the craps table. However, understanding the sequence of returns risk is an important part in retirement planning, and there are strategies that we will walk through that can be employed to help you handle it. The following are going to be some ideas to help mitigate the impact of the sequence of returns and what the sequence of returns does to your retirement plan. As illustrated previously, spending withdrawals taken from a depressed portfolio in Hobbes' scenario in the early years of retirement are most damaging. One strategy employed by advisors is to create different portfolios of risk as part of a client's spending strategy. Setting aside 3 years worth of projected withdrawals in a portfolio of low fixed income securities can help alleviate the need to sell more aggressive investments into a market downturn. Fixed income securities of this type typically have relatively nominal yields, but rarely are impacted by market downturns. In periods of positive returns, assets are cascaded from the more aggressive bucket into the short-term bucket to refill it back to the 3-year spending cushion. In times of market turmoil, the short-term bucket is spent down for up to 3 years so that the longer-term investments can be allowed to recover before withdrawals need to be taken. Make no mistake, employing the buckets of money strategy will likely reduce the overall return of the portfolio because a segment of your nest egg is deployed into assets with lower average rates of return. However, hedging against a large downturn in the early years of retirement seems worth the sacrifice. Remember, The goal is to make your assets last as long as you do, not necessarily outperform a benchmark every year. In our Calvin and Hobbes example, the assumption was that the same income was needed each year, plus a 3% increase for inflation, regardless of investment performance. When planning for retirement using modeling software, the assumption of consistent inflation is critical, and all care should be taken to assure that income can continue indefinitely, including this increase. However, when real bullets start flying in a retirement bear market, there's no rule which states that you must withdraw the same amount from your portfolio each year, nor must you add inflation adjustments. In fact, during serious bear markets, it's possible that inflation is negligible during that period and that investors might even spend less on discretionary expenses. Most people have some discretionary expenses as part of their retirement lifestyle, and therefore a little flexibility in the budget, if and when needed. If you're facing a 20% bear market, human nature is to pull back from expenses like travel and entertainment while the nest egg is under pressure. Doing so can positively impact the likelihood of the portfolio lasting to life expectancy because you withdraw less money while the assets are depressed. In addition, some studies have shown that spending is not linear in retirement. Although we are hesitant to building spending plans that rely on those assumptions, there's evidence that people spend more money in the first 2 decades of retirement than the later years. Travel and other discretionary expenses tend to decrease at older ages, while medical expenses become more prevalent. Whether you plan to spend less as you age or you're willing to put a little bit of flexibility in your cash flows during times of economic pressure, dynamic spending can help preserve your nest egg. If dynamic spending is combined with the buckets of money strategy, you can further insulate your portfolio from an early market shock, spoiling your best laid plans. Few products in the financial landscape garner as much negative publicity as annuities. Unfortunately, they are misrepresented at times by salespeople, further fueling the negative perception. However, the purpose of an annuity is to provide an income stream, and if used properly, they execute that mission. For our purposes, we are only discussing annuity income features like annuitization, an irrevocable stream of payments, or guaranteed withdrawal riders, which promise a minimum withdrawal annually, regardless of performance, as a retirement spending source. Please note, annuities have mortality and expense charges with additional charges for riders, investment expenses, and surrender fees. No claim should be made that an annuity will outperform other investments. In fact, there is a good chance they will underperform given their high expense load. However, an income guarantee can have merit in a retirement spending plan. As we learned earlier, withdrawals from depressed assets during the early years of retirement are the most damaging. However, if a segment of your portfolio is allocated to an annuity with an income guarantee, you can offload some of that risk to an insurance company. The insurance company assumes the risk of the assets lasting throughout the annuitant's lifetime. Because insurance companies have many policyholders going through retirement together, they can guarantee the income based on actuarial assumptions. Those statistics suggest that some people will not live to life expectancy, and in those cases, the income guarantee provided by the annuity wasn't really needed, and the insurance company pockets the fee they charged for the guarantee. Meanwhile, others live beyond life expectancy, causing the insurance company to fund the income even after the principal is depleted, whereby the insurance company takes a loss. To the investor holding an annuity income guarantee, the possibility of income even after principal is depleted can be thought of as a mortality credit. These mortality credits help hedge the risk of running out of money due to market downturns, whereas you might be forced to cut your withdrawals if there were no guarantee. One technique involves using an annuity to guarantee an income stream that matches the must-have retirement expenses. After accounting for Social Security benefits and any pension income if you have it, you can determine any additional income needed to meet the must-have expenses in retirement. Then, sufficient funds could be placed in an annuity that it guarantees that needed income. No ripoffs, no free lunches, guys. Annuities can be expensive, and it's important to understand the cost before purchasing the product. An annuity with a guarantee may cost you 2% or more than traditional investments due to mortality and expense charges, sub-account fees, and guaranteed income features. In addition, as we said before, annuities can come with surrender charges. What that means is you can't take the full distribution from the product for a number of years without paying that surrender charge. It's important to note that using annuities to hedge downside risk does nothing to protect against inflation. While the cost of living marches upwards, the income guaranteed by the annuity typically does not. In our opinion, annuities should not compose too much of your retirement portfolio. In fact, if one is committed to their investment portfolio and resists panic during market downturns, they might not need the expense of an annuity at all. Annuity income is merely another tool, similar to buckets of money and dynamic spending, that can help navigate the retirement income challenge. Here at Summit, we have various preferences for how much of your investable portfolio should be in annuities. Please let us know if you'd like to discuss this with us. It's easy to see why sequence of returns is a top priority for many investors. 3 decades of rising expenses, the tendency for investors to panic in down markets, low interest rates on savings, retirement income risk, and lengthening life expectancies combine to create quite the puzzle. But knowledge is power, and with an understanding of the risk comes the ability to build a strategy that matches your retirement spending needs. If you haven't done so already, make time to design your desired standard of living in retirement. Give special consideration to want items in addition to the must-have expenses. If you're going to leave your paycheck behind and choose to retire, you'll have more fun in retirement if your strategy includes fun things to do. Sit with your advisor and map out those expenses, including inflation, for the rest of your life. Doing so should give you a clear picture of what you'll need to live the life you imagine. Then, with that spending plan in hand, build your investment strategy accordingly. Work with your advisor to determine if buckets of money would help weather an early downturn in the market. Or perhaps you'll decide to spend a bit more in the early years because you know where you can cut expenses in a downturn or later in life. Perhaps you'd feel more comfortable sticking with your investment portfolio if some portion contained an annuity guarantee, despite the fees. There's no magic formula for the perfect retirement spending plan. However, a well thought out strategy that matches your goals and allows you to stay committed will give you the best chance at the retirement you have been working towards. At this time, guys, I'm going to go ahead and open it up for questions. So first question that we have here is taxation. Taxation seems to be a big question in retirement, and rightfully so. If you've got pension income, that's going to be income taxable. A portion of your Social Security will be income taxable at the federal level. Depending on your state of residence, your Social Security may or may not be income taxable. And then your required minimum distributions, any money that you take out from your IRA accounts, 401k accounts, or 403b accounts, is going to be income taxable in retirement as well. So when you're creating that plan for your future and taking a look to see what your income needs to be to meet your expenses, you want to make sure that you're planning in there with the taxes as well. And I would say there's really not a way to get around taxes with our current tax code. Most people are taking a standard deduction. We are not CPAs, so we cannot provide tax advice, but you can always gift. You can always do a donor advised fund, which is going to be a charitable contribution, which will help with some taxation. And those are strategies that may be able to help lower taxes down the line. If there's any questions, guys, don't hesitate to type them into that Q&A box and I'll monitor it for the next couple minutes. Otherwise, we'll go ahead and wrap this webinar up and we should be able to have another webinar out to you guys within the next couple months. There's a question that came in regarding Medicare costs. So when you're 65, you will go on Medicare. There will be costs associated with Medicare. And when we're doing planning with clients, we're estimating a cost of, depending on your income, because Medicare is based on your income, we're planning for a cost of somewhere between $500 a month per person to probably $700 a month per person. Obviously, if you're going to choose a supplemental plan, that's going to be your Part C for Medicare. That costs a little bit more. It could be slightly more, slightly less. Medicare has 4 components. You've got Medicare Part A, which is offered to you free because you've paid into that through your FICA taxes over the years. Medicare Part B comes with the cost. Medicare Part C is your supplemental plan, and Medicare Part D is your prescription drug plan. And all of those are going to come with a cost to you in retirement. Question in retirement, and the question's coming through as, does it make sense to have money in a Roth IRA in retirement? So you can't contribute to a Roth IRA unless you have earned income. So if you have earned income in retirement, you're more than welcome to contribute. You can do Roth IRA conversions any year in retirement. And what that means is that you're taking money from your IRA account and you're going to pay taxes on it, and you're converting it over and putting it into that Roth IRA account. Now, Roth IRA conversions are a technique that we do with clients on a year-by-year basis, depending on what their taxable income looks like. Roth IRAs are some of the best investment vehicles because they're double tax-free. When the money goes into the Roth, you've already paid the tax, the funds grow, and when it comes out, they're not income taxable to you. In addition, you don't have required minimum distributions on Roth IRAs like you do on traditional IRAs. So Roth IRAs are always a good option depending on how you can get money into them. There's a couple different ways to do so. I would work with your advisor and your CPA to go ahead and determine whether or not you could put money into a Roth IRA and the best way to do so. All right, guys, thanks for joining us today. We really appreciate it. Questions or concerns, don't hesitate to reach out. Summit is always happy to be a resource to you. Otherwise, I hope you all have a wonderful night and look forward to seeing you in a couple months at the next webinar. Take care.